The following podcast was recorded on Thursday, May 26, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, Kristen.
Good to see you this week. We're anxious to hear your latest on how consumer choices have pivoted. Last week, we had Walmart and Target missed earnings. We've had Snap. Is this a collapse of the U.S. consumer to bear weight given the elevated prices?
It's interesting, right? It's pretty easy to read, what Walmart was saying, what Target was saying, and say, "Ooh, this looks like a collapse of the consumer. Maybe they can't handle the prices, et cetera, et cetera." But that seems to be a little bit of I call it a premature assessment of what's actually happening in the U.S. economy. And then this whole idea that Snapchat is some sort of bellwether technology company, telling us that the world is collapsing, I think is a little bit aggressive for a couple of reasons. One, it's not really indicative of the wider U.S. population. It's really indicative of spending from startup technology companies, et cetera, to advertise, right? It's an advertising company. Advertising is highly cyclical. But when you have companies like Peloton unable to sell their bikes, right, they're not going to advertise, right? And so I think there's a little bit of you can call it a startup cycle, right? There's a San Francisco problem, not a San Diego problem.
So it's not a real reason yet, maybe yet is the key word, that we should be concerned about the state of the consumer and the economy?
Yeah, exactly. It's not it's not like, the U.S. consumer is fine and will be fine forever, right? The U.S. consumer will at some point pull back, and high prices could be one of the catalysts for it. But it's a little early to say that the U.S. consumer is actually, in bad shape. I think we have a chart of same-store sales from Redbook here. Same-store sales are up 13.1%. I mean, that is a big number. That's not a number you see in the middle of a recession driven by the consumer, right? Normally, call it pre-COVID, you'd be in the 5% range and thinking that was really, really good. And it's not like these numbers are rolling over easy numbers either, right? They're rolling over pretty strong same-store sales figures from last year. It's pretty hard to say that the U.S. consumer is falling off a cliff here. It's probably just that, they're not buying as much stuff at Walmart and Target. I mean, Dollar Tree had fine earnings, Dollar General had fine earnings. I think there's a little bit of a shift in how the consumer is spending, not necessarily, a collapse there. And it's interesting to also point out, right, there were a lot of COVID darlings in terms of consumption, right? So instead of, when we were trapped at home, we bought a lot of stuff to do sports, right? We went out and we bought a lot of stuff at Dick's Sporting Goods, et cetera. And now that, we're back in the office, we're actually working again, we're doing a lot less buying of those sports equipment stuff, right? We don't have to have that home gym built out. We're not able to golf as much, right? We're back in the office. So I think there's a call it a subtle shift in the consumer that I think is being read through way too much here.
So as the consumer consumption basket has changed, as you mentioned, since the beginning of the pandemic, what has that impact been overall for the retailers?
It's been hard to read, right? It's really hard to do your inventory correctly when the consumption basket shifts back and forth in kind of a wild manner. It's really hard, right? And I think we saw that from Target, we saw that from Walmart, we even saw it from call it Home Depot, right? Inventory levels to sales are wildly elevated relative to what they were pre-COVID. Part of that is, right, they weren't sure they were going to be able to get that inventory, so they over-ordered. And now they can't push it, right? We bought a lot of clothes early on in the pandemic, right? We're not buying as much clothing now, which is kind of awkward considering we're going back to the office a lot of the times. Food actually isn't making up that much on a same-store sales basis, which is kind of intriguing here, particularly given how much those prices have risen. But what's really booming, so to speak, is souvenirs, gifts. And I think that is a little bit of a hint as to what the consumer is actually wanting to do here. The consumer is out and about doing things, buying stuff for other people, and going on trips.
So we're seeing that pent-up demand come into place.
Yeah, exactly, right. For the last 2 years, it's been pretty difficult to plan a vacation and actually go on it consistently, right? You couldn't go to Europe, you couldn't do a lot of things that you wanted to do. Now most places are open with the exception of China. Not many people want a vacation in China, but aside from China, it's pretty well open. There was an interesting commentary from an Australian firm that was looking at what bookings were in France and Spain, and if you look at June and July, it's well over, like pretty close to double digits, well over what it was in 2019. So people are going on vacations and they're doing it. I would say, come high prices or shortages. It's pretty much I don't really care how much this costs. We're going to go to the beach.
And we've mentioned on this podcast series before, we focused on Vegas. In particular, what is Vegas really telling us in terms of consumer demand? You mentioned people are willing to spend. Are they willing to gamble again?
I would say yes. They're willing to gamble again. I think this chart shows it pretty dramatically. It's interesting because Vegas is one of those places you just don't really have to go. And it's kind of I would say it's a two-part market. It's a conference market. You go there for business conferences, etc. And you go there for pure entertainment, right? It is not a place that, you go, because you want to see what's going on. It's not Paris. It's Vegas. And when you go there, it's pure discretionary spending, right? You are going there either to go to a conference, which means that the world is reopening, or you're going there to throw down on the slot machines and poker. And those are two things that, on the margin, you don't actually have to do. And the easiest way to kind of get a feel for what's really going on there and how much demand there is to look at, what RevPAR is doing, revenue per available room. And that's back to pre-COVID levels, if not a little bit higher. And that trend does not appear to be isolated only to Vegas. That trend is pretty much every major vacation and discretionary spot on the planet is seeing RevPAR numbers pretty strong here.
So Sam, in summary today, what should we be watching for next in terms of retailers, the state of the consumer, and also the state of the travel industry?
I think it'll be really interesting, to watch a couple of things. One would be what's going on with TSA passengers. How many passengers is TSA checking in per day? That looks to be back to, call it, close to 2019 levels. So that, I think, is a really interesting place to begin watching for the summer of travel. I think another one will be commentary from the airlines and what they're seeing. There's a pretty significant pilot shortage at the moment, which is causing plane tickets to rise. They simply do not have the pilots to put more planes in the air at the moment. A lot of retirements happened previously, so those prices are elevated and people don't care. People are still buying those plane tickets and they're buying them at very high prices. Doesn't really have that much to do with fuel costs, ironically enough. Even with, call it, oil at $110, $112 a barrel, it has nothing to do with oil, right? They would put more planes in the air and get ticket prices down, but they can't. So I think that's a really interesting and intriguing place to watch for the summer of travel. If you continue to have very robust travel metrics, it's very difficult to see the consumer as having cracked at the moment. The low-end consumer, bottom couple of deciles of income, they are feeling the pain, they are pulling back, but the top deciles where the most spending happens are in very good shape in terms of their balance sheets and are continuing to spend at a pretty rapid rate, which will be good for the economy through the summer.
Well, thank you, Sam, for your thoughts today. Thank you, everyone, for joining us. As a reminder, we are client-driven. If you have any questions or feedback on future topics, please let us know. For any information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Thanks, everyone, and have a great day.